All right, everyone. So the other video, we went up to chapter 4. I think I'll do 5, 6, 7, and 8 on this one. These are going to be a little bit meatier, like full of meat in these chapters, mainly because provision riders and options, that is one of the harder chapters on the test exam. Usually people have low scores on provision riders and options and annuities. So we're going to go 5, 6, 7, and 8. And group life is pretty easy. I think underwriting is all right. So riders is probably going to be the fun chapter on this section. And then the last part we'll do 9 and 10. 9, 10, 11, and 12 for the third video. So we'll try to keep this one under an hour. The last one was about an hour. So we'll go to review. Provision riders, again, these are like the add-ons. If you're going to buy a base model of a car, the riders are pretty much the add-ons that you can pay extra for, okay? So if you're going to add any riders, just know that you're going to be paying extra to have it in your policy. What happens when a policy owner borrows against the cash value of his life insurance policy? Okay, when you borrow against the cash value of your life insurance policy, you'll have a loan on it, and if the loan is outstanding, it will accrue some interest, okay, depending on what company provider you have and what the interest on that will be. And anything that is not paid before the time of death or surrender, that will be deducted from the death benefit at the end. So let's see what the answers are. What happens when a policy owner borrows against the cash value of his life insurance policy? The amount borrowed is added to the policy's gross income for tax purposes. That's not true. Any borrowed or loans do not count as income. You don't pay taxes on it. You just get charged interest rates. The policy proceeds would be reduced by the outstanding loan balance. The interest on the loan is tax deductible. That is not true. And no additional loans can be taken out in the future, and that's not true. Cash value, if you have any cash value in there, then you can borrow from it. So this one's going to be the policy proceeds would be reduced by the outstanding loan balance, okay? And that includes any accrued interest over the years. A life insurance policy owner would like a dividend option that results in a limited current outlay of funds. Which dividend option would be chosen? All right, when you think of dividends, it's going to be a mutual company. And in this case, it's asking for limited current outlay of funds, meaning pretty much if they were to use their dividends, how can they reduce the amount of money that they would have to pay into their policy, pretty much. And that's going to be reduction of premium payments. Excuse me. Paid up additions is just you take the dividends and you buy whatever amount of term coverage you possibly can, and it'll be added to the policy. That's what paid up addition, like, it's paid in full. And that's in what way is the life insurance policy affected by an accelerated benefit payment? Accelerated living benefits is pretty much long-term care or any critical chronic terminal. So if you're advancing the money from the death benefit for some sort of long-term care like purpose, it's going to decrease the death benefit, okay? It's going to take out from the total of the coverage. It's not going to decrease the premiums. It's not going to increase the policy loan balance. Accelerated death benefit does not take out a loan from the cash value. It takes it straight out of the death benefit. Tim is confined to a nursing home but does not have terminal illness. Which life insurance rider is designed to help pay for this type of expense? Accelerated living benefit rider, viatical rider, long-term care benefit rider, and cash value. So he's in a nursing home, but he does not have terminal illness. So basically, he's going to get the long-term care benefit rider. Okay. What could be the potential result of taking out a cash value loan under a life insurance policy? What could be the potential result of taking out? Reduces the amount receivable upon surrender of the contract. death benefit will be subject to income taxes if the insured died with an outstanding loan balance. In that statement, the death benefit will be subject to income taxes. The death benefit will not. The loan might be if you took out more than what you put in, but not the death benefit. Interest that accrues on a policy loan is tax deductible to the policy owner. Loan amount will be added to the policy owner's gross income. What could be the potential result? It's going to reduce the amount receivable upon surrendering of the contract. What effect can a long-term care benefit rider have on a life insurance policy? Again, if you need to use the long-term care, it comes out of the death benefit total, right? So if you're going to use or activate the long-term care rider, you're going to have reduced death benefit, okay? What happens to a life insurance policy when the policy loan balance exceeds the cash value? If your cash value life insurance runs out of cash value, the policy will lapse, okay? So if your cash value is ever zero, and if you're taking out a loan that exceeds that cash value that's in there, your policy will no longer be in force. Which life insurance policy provision allows a policy owner to cancel the policy and receive a full refund within a limited time period after policy delivery? That's going to be, well, let's look at the options. Free look period, incontestable period, elimination period, and grace period. Grace period is if you miss a payment, they give you, a grace period of how many days that you can pay before it counts against the policy. In some cases, if you miss a payment, it could lapse. Incontestable period, that's the 2 years that they have to really look over medical records and files after they approve the policy to see if there's anything that they might have missed. In this case, the free look period is going to be that window of time that you can still cancel and get all your money back. What is considered the collateral on a life insurance policy loan? All right. So what are they going to hold as collateral in the event you need to borrow money from your own policy? It's going to be the cash value. Okay. It's not going to be the death benefit. No one's going to get you $1 million policy and let you borrow $1 million when you made like a $100 payment. They're going to use the cash value as collateral. So pretty much, if you don't have any more cash value, there's nothing else that you can borrow from. Which of the following is true regarding a person receiving a waiver of premium benefit? Waiver of premium is in the event that you're disabled, can't work, or the payer, waiver of premium, can't keep up with it. They waive the premiums so that the policy doesn't lapse, okay? So in this case, the insured must be disabled for a period of time. The insured must expect a total recovery within 2 years. The insured will not qualify for workers' comp. The insured will not qualify for short-term disability. All of these other words are added, like short-term disability, workers' comp. They're just added in there. There's no recovery requirement for something like that. So the insured must be disabled for a period of time. And during that time, they're probably not able to work to generate the income to make the payment. It's not automatically added into policies. This is a rider, again, that you have to buy, which means you're going to pay a little bit more from the very beginning to have something like that. Which of these is not a common life insurance non-forfeiture option? Reduced paid-up insurance, cash surrender option, extended term option, life income annuity. This is like a whole different product, okay, when you see the annuity. Reduced paid-up, again, you're just taking the extra money and you're buying additional term for whatever, that amount of money can buy. Cash surrender is pretty much, you have the return of the cash, all the different options that you have with your cash value, or an extended term. Which statement regarding the life insurance premium for a children's rider is true? No premium is normally charged for a children's rider, decreasing premium as each child becomes an adult. Premiums remain the same no matter how many children, increasing premium as additional children are born. There are no names, no numbers, no ages to the children riders. It's just a blanket charge, so you can have 1 child or 10 child. It'd be the same. So in this case, the premium remains the same no matter how many children is most likely the answer. A policy owner has a life insurance policy where she had listed her age on the application as 5 years younger than her actual age. That allowed her to, have a lower cost of insurance. If she dies and the insurer discovers the misstatement of age, how much will the insurance company pay? Well, if she was 5 years younger and they found out, that means she's been paying lower cost of insurance, meaning that she should technically have less death benefit if they corrected her age. So the insurance company will not pay the full face amount. They will definitely not pay more than the face amount. They will pay something, but they'll pay less than the face amount. An insured has a $25,000 whole life insurance policy with $6,000 cash value available. Under the extended term non-forfeiture option, what is the amount of insurance available to the insured? So this is basically, they throw in, and you'll see some of these questions where they'll throw in a lot of numbers and think you have to do all this, hardcore calculating. But the total amount that this person is insured for is still $25,000. Especially in a whole life, the cash value will one day equal the death benefit. So whole life, when you pass away in a whole life, they'll keep the cash value, but they'll pay out the death benefit. Or if you want to look at the other way, they'll give you your cash value back, but they'll reduce the amount of coverage that the insurance company is going to pay. Okay, so either way, the $25,000 is what you're going to get total. It's not the death benefit in addition to the cash value in most whole lives, unless it's designed for cash accumulation. But they have a different way, a more unique way of setting that up. Option 2 for some people. How is the insured protected if a payer benefit rider is attached to the life insurance policy? The payer is the person that is paying the life insurance, not necessarily the owner or the insured. How is the insured protected if the payer benefit rider is attached to the life insurance policy? Policy loan will automatically cover the premiums if payer becomes disabled or dies. Premium payments are waived in the event the premium payer dies or becomes disabled. Premiums are waived if the payer becomes financially insolvent. Policy loan will automatically cover the premiums if payer becomes financially insolvent. It's going to be premium payments are waived in the event the premium payer dies or becomes disabled. In the event of a disability or a death, they don't automatically use a policy loan or a cash value to cover the premiums on something that is a permanent problem like that. Okay, like if you miss a payment, they might pull cash value out of your policy to pay for it. But if you're disabled with no recovery in sight, they're not going to continue to just pull out. But if you don't have a rider, then they'll do that, not as a loan, but they'll just use it. They'll just deduct it from the cash value until it runs out, and then the policy will lapse. A life insurance policy provision that has the ability to reduce the death benefit is called a life insurance policy provision. Okay, so there's going to be some sort of add-on in the life insurance policy that has the ability to reduce the death benefit. Spendthrift clause is just saying, you don't want your beneficiaries to spoil all the money at once. Payer benefit is more for the payer of the policy. Insuring clause, we're going to go with accelerated living benefit because it is in addition to the policy that can potentially reduce the death benefit if activated. Again, that's like long-term care, critical, chronic, etc. What happens to the death benefit of a life insurance policy if the insured elects a partial payment from the accelerated living benefits provision? All right, so if you have activated accelerated living benefits. It's what effect does it have on the death benefit? It's not going to increase the death benefit. No change, none will be given. Those aren't the answers. If you activate accelerated living benefits, you're going to reduce the death benefit. When a lapsed policy's premium has been paid current, so you owed a few months, you paid it to catch up, so now it's current, it has the potential of being reinstituted, restored, renewed, or reinstated. The terminology for this one is going to be reinstated. Okay, you want to reinstate a policy that may have lapsed. How may an insurance company classify an accidental death benefit on a life policy? How may an insurance company classify an accidental death benefit on a life insurance policy? As a provision of the policy, as a mandatory policy rider, as an optional policy rider, as a non-forfeiture option. It's going to be an optional policy rider. A life insurance guaranteed insurability rider. So in guaranteed insurability just means they're not going to do a health check all the time if you want to increase the death benefit amount, okay? If you lower or reduce the death benefit amount, they're not going to check your health, they'll just reduce it. But if you want to increase the death benefit later on, they're going to check for your health. But a guaranteed insurability rider pretty much waives that. So the question asks, a life insurance guaranteed insurability rider gives the insured the right, without proving insurability, to purchase life insurance on a spouse, purchase life insurance policy on his children, periodically purchase additional insurance, purchase additional life insurance at any time. It's going to be periodically purchase additional insurance. It's not going to be at any time because, again, if you're too old or, there are going to be some conditions. And that is Chapter 5, Provisions and Riders. It is one of the tougher chapters. Most of it is just terminology. If you understand the riders and stuff, it's really not that bad. Chapter 6, we're going to go into life insurance premiums, proceeds, and beneficiaries. When a policy loan is requested by a policy owner and it requires the consent of the beneficiary, what kind of beneficiary designation is this? Okay, usually the policy owner has full control of the policy. How they pay, the amount, the cash value, withdrawing, borrowing, etc. They have usually full control. But in this example, in order to make changes, the beneficiary has to be notified and be given and give permission. So is this going to be an irrevocable beneficiary, a collateral beneficiary, a revocable beneficiary, or per stirps beneficiary? And it's going to be irrevocable. Irrevocable means that it's tough to change. There's a lot of guidelines in place. So in this case, the beneficiary is someone that is a little bit more of a permanent person that cannot be changed out. And any major changes need to be approved by the beneficiary. So I'm going to go with the irrevocable beneficiary. Where will a life insurance policy's proceeds be directed to if all the beneficiaries die before the insured? It's important to reach out to clients that you have to update their beneficiaries, or just do the reviews and keep things updated, because sometimes situations like this do happen, or people divorce and get into new relationships and they still have their exes on as beneficiaries. But in this case, if all the beneficiaries die before the insured, it's going to go to the insured's estate. Okay. Death benefits from a life insurance policy are normally considered to be subject to attachments from the insured's creditors, subject to the cost recovery rule, subject to the value added tax, exempt from federal income tax. This is going to be exempt from federal income tax because life insurance is tax-free. There are certain times when it is taxable, but we're not going to get into that. Which life insurance settlement options life insurance settlement option pays a stated monthly benefit until both principal and interest are exhausted. Fixed period installment just means that you want it for a certain amount of time. Let's say you want it for 20 years. They're going to break it up into 20 years. So fixed period is time related, okay, on how you want the payouts to play out. Fixed amount installment option, that tells that you need a certain amount every single month. That's what you want. So they're going to do that until the money runs out. It can last 5 years. It can last 50 years. It all depends. Interest only option or life income option. And this is going to be the fixed amount. So you're just it's just going to pay out interest and principal until all of the money in there runs out. Which of the following statements about the installments for a fixed period settlement option and life insurance policy is not true? Fixed period means, again, you want it for a certain amount of time. The longer the period of time, the smaller each installment. The longer the period, the smaller. Yes, that makes sense. The installment payments are composed of both principal and interest. That is true. The shorter the period of time, the larger each installment. That is true because the first one is true. So if you're paying out $10,000 in 10 years, it's going to be $1,000 a year. Okay, so the longer the period, the smaller the installment. But if you did $10,000 over 5 years, you're going to get $20,000. Or let me see, what did I say? 5 years, $10,000, $2,000 a year, right? So the shorter the period, the larger the installment. Okay, the periodic payment amount is determined by the beneficiary's age. The other three seemed right, so I'm going to go with this one. Which statement best describes a single premium whole life policy? That means you have a lump sum of money and you're just paying it in full, and that's it. Your policy is paid in full. You don't have to worry about the payments. You have the coverage protection in a whole life policy to age 100. Okay, so single premium that is due annually, that is not true because it's a one-time pay single premium. Paid up policy that offers limited protection. It is a paid up policy, but the protection is paid in full. Paid up policy that offers lifetime protection. That is going to be true. Premium that can only be paid from a single source, and that's not true. Lifetime, again, to age 100. Okay, so whole life expires at age 100. Which of these is an accurate statement regarding the fixed period settlement option? Fixed period, so it's time related on a life insurance policy. A portion of payments paid to the beneficiary comes from interest generated from policy loans. Not true because of policy loans in that sentence. A portion of the payments paid to the beneficiary comes from interest calculated on the proceeds of the policy. A portion that can be true. Payments can be adjusted monthly by the beneficiary. Because it's a fixed period, you're not going to be able to adjust it because it's already been calculated to make sure that it meets that period of time. Payments are normally guaranteed for 10 years or more. That's debatable. I'm going to go with this one because the interest calculated on the proceeds of the policy comes from so a portion of the payments come from the interest. Which tax is normally associated with an individual's death? So the death tax is going to be a state tax, okay? Federally, it's around $6 million, $7 million. But Trump, back in 2016, raised it to $12 million. But it expires at the end of this year. So if it doesn't renew, in 2026, it'll go back down to $6 million. But right now, it's considered $12 million for the federal estate tax. So anything over that gets taxed, I think, close to 50%. A life policy spendthrift clause would have no effect if the beneficiary is paid the proceeds. Spendthrift, again, is if, let's say, you're leaving money to your kids and you don't want them to get $2 million all at once. You know what I mean? So spendthrift is to make sure that they don't ruin, spoil themselves, that they don't squander away all that money. All right, so that's what the spendthrift clause would do. You would pay out, like, maybe monthly or a little bit at a time, so that way they don't get all the money at once. But in this case, the clause would have no effect if the beneficiary is paid in full. Okay, so It only works if they're incremental payments, and everything else, a fixed amount installment, life income option, fixed period installment, those are all spread out over time. Lump sum is the only one that will give the beneficiary all the money at once. Okay, so the spendthrift clause would be useless if you're going to pay out all at once. How long do most states allow an insurance company to delay the payment of cash surrender under the delayed payment provision? It's going to be 6 months. What effect does interest income have upon insurance premiums? What effect does interest income have upon insurance premiums? Adjusts premiums on a quarterly basis, decreases the premium, levels the premium, increases the premium. Interest income will end up allowing people to pay less for their policies. So it's going to be decreases the premium. The actuarial formula for a bundled insurance premium is as follows. Mortality cost based on age and gender. Mortality is the death cost. Less assumed interest, so the death cost or the mortality cost minus the interest is how they determine the premium. Okay? So please note that the assumed interest always lowers the mortality cost and thus lowers the total premium. What kind of arrangement gives the policy owner the right to change the beneficiary? Okay, so the other question asks if you needed permission from the beneficiary to make changes. In this case, the policy owner has the right to change even the beneficiary out. So this person has full control of the policy, and it's going to be a revocable designation. Revocable meaning you could take it back. So, like, you know what I mean? You can remove somebody and give it to somebody else. Which statement regarding the joint and survivor life insurance settlement option is not true? Joint and survivor means that there's two people on it, and usually it's the payout after the second person passes away. Joint would be when the first person passes away. Okay? So which of the statements is not true? Two or more beneficiaries can be paid. Which is true? Income continues until the last beneficiary dies. I don't know about that one. Age of the beneficiaries play a factor when determining the payment amounts. I don't know if that's true. This one, I don't know. I'm probably going to get this one wrong. The amount of each installment is larger than the single life income option. The amount of each installment is larger than the single life income option. It might be that one. The amount of each installment is larger. So which statement regarding the joint insurance settlement is not true? It is. Okay. And that's mainly if you're buying a joint and survivor, it's going to be less expensive than buying two individual policies. The amount of each installment would actually be larger with single life income option as opposed to a joint and survivor option. Policy owner with terminal illness who sells his life insurance policy to a third party is called the viatical. Viatical would be the process with viable or viator or viator. It's going to be the viator. These are life settlements. People can sell their life insurance at a discount just to get cash, which is kind of a pretty cool concept. It's actually a whole business out there. There's people that they look for life insurance policies that aren't really needed anymore, and they buy it from people, which is kind of cool. I mean, you could literally create a whole niche, and they need a licensed agent to change the owner and beneficiaries and all that stuff. So it's an actual business. During the early years of a whole life insurance policy, the cash value in the beginning years of a whole life insurance policy, the cash value will normally be less than the total premiums paid, more than the total premiums paid, equal to the total premiums paid, unavailable as a policy. As long as, in the early years, as long as you have money in the cash value, you can take out policy loans, because some people overfund and dump in a lot up front, or they have a lump sum that goes in. So that's not true. equal to the total premium paid, and that's not the policy value is not always going to be. It's actually rarely, even in the beginning, like even if you put in a lump sum, your policy value and your cash value is rarely ever the same. And obviously, you're not going to get more than total premium paid. It's going to be actually less than the total premiums paid. All right. Chapter 6. Chapter 7 is underwriting and policy issue. After an applicant reads and signs an insurance application, he or she should be conscious of the fact that the premium quoted by the agent is final. That is not true. They still got to go to underwriting, check all the blood work and medical history and all that stuff. The insurance company will determine the premium before actually giving it back. A false statement could lead to loss of coverage. That is potentially true. If you made any false statements, the contract or the agreement would be void. The policy is guaranteed to be issued. That is not true. Again, they go through their process. Premium refunds are not allowed, and that is not true. Some people actually use that scare tactic, that if they cancel their policy, they're going to get sued or charged. Don't do that. You can lose your license for that. So a false statement could lead to loss of coverage. That is the answer. Which of these is not an underwriting responsibility of a life insurance agent? Okay, not the responsibility. Ordering an inspection report, yes. If we feel like we need to, we're gonna make those decisions. Requesting and attending physician report, yes. Determining the final rate classification, that's a no. Asking relevant questions concerning applications. Yes, so our job as a field agent is, be the eyes and the representative for the life insurance companies. All right, but the thing that we do not have authority to do is determine what their final rate classification is going to be. We're going to have to pay more or less based on anything that we observe or our opinion. When a producer submits an application that discloses personal information regarding the applicant, who supplies the privacy notice? This seems pretty straightforward. It's not going to be the underwriter, not the insurance company. The producer is us, and then the fiduciary agent. It would be us. Okay, so we're sitting there going through. We're supposed to leave them documentation, informations. Send them a copy of their illustration if you have it. Marketing materials, but it is our job to make sure that we provide them with the notices. An insured may be required to sign which document at policy delivery to ensure there has not been any adverse medical conditions since the time of the application. So the insured may be required to sign what document at policy delivery to ensure that their health and safety has not changed since the last time or when they first started the application. MIB disclosure, binding receipt, agent's report, or good health statement. This is going to be a good health statement, okay? To make sure that nothing has changed, nothing dramatically has changed since the time they first looked into this policy and submitted the application. The initial premium for a life insurance policy is typically paid in what way? The producer pays from any commission received. That's very nice of you if you decide to do that. It is typically obtained by the producer and forwarded to the insurer. It is typically forwarded by the insurer to the insurer by the applicant. The applicant mails it to the insurer after the policy has been approved. C and D are potential ways that they can do it, but typically we would receive the payment at time of application, okay? And we would just forward it with the application. Which of these is not used as a selection criteria in the underwriting process of a life insurance application? The age, definitely going to use the age. It's going to determine the cost. National origin, where you're from around the world, probably not. Credit report, they're going to want to know that. And the gender or sex, they're going to want to know that also. So in underwriting, they're gonna check for age, credit report, and sex, not so much national origin. Credit report mainly to see, if you're able to afford the policy, if you're in any risk, in need of money situations, things like that. Field underwriting by a producer is illegal in most states. That's not true. Field underwriting by a producer is used to reduce costs to the insurer, may result in the disclosure of hazardous activities of the applicant, involves conducting a physical examination of the applicant. As a producer, don't go out there conducting any physical examination as part of the process, okay? Be frowned upon. This is going to may result in the disclosure of hazardous activities, because we are, again, the eyes and ears for the insurance company. So if you're going to walk into a client's house and they have alcohol bottles everywhere, there's dirty diapers laying around, they're in a hazardous situation, then, you want to kind of make note of it, okay? The MIB consists of members from which group? The Medical Information Bureau is a group of insurance companies. They will go through all medical records. Anything that's ever been documented, they will find it. And then they'll determine, their underwriting. When must a producer provide disclosure about information practices to an applicant? Immediately after signing the application, during the medical examination, upon policy delivery, or prior to the time of signing of the application. It's going to be prior to. You're going to want full transparency. Just lay everything out so that way they know exactly what they're getting. K is an agent who takes an application for individual life insurance and accepts a check from the client. He submits the application and the check to the insurance company. However, the check was never signed by the applicant. If the application is approved, when will coverage be effective? It's going to be effective when the company receives a signed check. Okay? So not the date of application, because the check, again, was never signed, so it wasn't complete. The date the sales appointment was made, no. The date the agent delivered the policy, collected the initial premium, and obtained a good health statement from the insured. Yes. The date the application was submitted to the insurance company. No. Now, if the check was signed, then it would be D, okay? If the check was signed and it was good to go, then the date the application was submitted to the insurance company with that check would have been the date that the client would have had coverage. Group life is actually I think group life is pretty easy, but we'll see. Alright, last section for this video. If you know any companies, business owners, organizations, fraternities, anything like that, you can offer them group life insurance, alright? It's usually a term. Group life insurance is typically issued as level term insurance, okay? You could do final expense, but if you do a permanent policy, every single member would have to go through medical underwriting. Okay? Group term is just easier because they don't require the whole medical underwriting. They don't care about the health or anything like that. They just buy a blanket coverage. But if you do group permanent, then each person would have to have their own profiles. What are premiums for group credit life insurance based on? What are premiums for group credit life insurance based on? Flat rate, unrelated to the borrower's age. That sounds right. The age of the borrower at the time of debt is incurred. The age of the borrower when debt is paid off. The average age of the borrower over the life of the debt. A group credit life insurance, they're not going to really care about the age. They just care about their repayment of the debt. Okay. Premiums for group credit life insurance are based on claims experience and expense factors, not necessarily the borrower's age. What minimum percentage of all eligible employees must participate in a group life insurance plan if the premiums are completely paid for by the employer? If the employer is paying for the premiums, then 100% participation rate. All the employees would be covered. Okay. Versus if the employer is paying some, and then the employees have to pay some, then I think it's 75%. If an employer pays for accidental death and dismemberment insurance for its employees, the amount paid by the employer is generally tax deductible to the business. Okay, that's why they offer benefits, to attract employees and stuff like that, but mainly because it becomes a tax write-off for the company. The policy provision that permits an employee to change from group life coverage to an individual life policy is called a conversion provision. Certificate provision, assignment provision, modification. Conversion provision is probably the closest one. Alright, so the conversion allows an employee to change from group coverage to an individual life insurance policy. What is an insurance contract that identifies individuals by relationship to a specific organization? Employer insurance, group insurance, industrial insurance, COBRA plan. It's going to be group insurance. Industrial insurance is kind of like if you're if everyone's like an electrician or something, or if everyone's into construction. But in this case, we're a specific organization, we're just going to go with group insurance. Which statement regarding the certificate of insurance is accurate? And sometimes when you're applying for some things, they want to see that you're coverage or that you have the insurance coverage. Okay, so that's what a certificate of insurance pretty much just states, that you are covered. It is issued by the employer to the employee, usually upon request. Each certificate of insurance is underwritten on an individual basis. That is not true for group life, group term, unless it's a group permanent policy, but it's not specified here. It is an insurance contract between the employer and the insurer. No. It indicates evidence of an employee's insurance coverage. Okay, so evidence of an employee's coverage, yes. Why do insurers require a minimum number of employees participate in a group insurance plan? Why do insurance companies require a minimum number of employees to participate in a group insurance plan? Minimize adverse selection. This so happens to be the first one. Claims are minimized, efficiency is maximized, profits are maximized. It's not for the profits, they're going to make money regardless. Efficiency, not so much. Claims are minimized. No. Minimize adverse selection. They don't want all the 80-year-olds with cancer selecting it. Okay, they want a wider variety versus just the ones that really need it. The conversion option for group term insurance may be exercised by an employee at any time while still employed. A conversion option, again, is usually when they leave the company and they're taking on the payments themselves because they're no longer covered by the company. The conversion option for group term insurance may be exercised by an employee at any time while still employed, within 2 years of the hire date, within 31 days of terminated employment, or after providing proof of insurability. They only have 31 days. They have 1 month to make that decision if they want to keep it or not. After that, they would have to go through an agent. Which type of policy can group term life insurance normally be converted to? Term usually converts to a permanent policy, okay? You don't see permanent converting to a term. An individual permanent life insurance policy, an individual level term, a group permanent. It's not going to be a group permanent. An individual renewable policy. It's going to be an individual permanent life insurance policy. All right. So that is chapter 5, 6, 7, and 8. And then I'll make another video on 9, 10, 11, and 12. 11 and 12 hasn't been activated yet, but we'll get that.